Welcome to Talking Business, a podcast produced in Melbourne, Australia. The podcast is available on the Acast site, my own website, the Apple Podcast Store, or wherever you go to get your podcast. Or you can get it at the Business Acumen website at www.businessacumen.biz or at Banking Day. For the most exclusive access to leading economists and business leaders from around the world, subscribe to Talking Business from my website, leongettler.com. I am Leon Gettler. My job is to review and monitor the week's news in business, finance and economics. I bring it all to you every week. This is episode number 23 in our series for 2024, and today's date is Friday, July the 5th. First, I'll be talking to Deborah Rathjen, the CEO of biotech firm Carina, an Australian clinical stage immunotherapy company researching and developing CAR-T therapies for personalised cancer immunotherapy treatment. And I'll be talking to economist Nicholas Gruyan about why Australia's anti-corruption watchdog and the Public Service Commission took no action over the Robotech Commission's findings on the scandal. First, let's talk to Deborah Rathjen.
Well, Deborah, what led you to join Carina Biotech in 2020?
Well, I joined in mid-2020, which was an unreal time. It was the middle of the pandemic, if you remember, and so it wasn't sort of a natural thing to be thinking of joining a new company. But, you know, Carina has a great history in terms of the way that the company was founded as part of the CRC, or Cooperative Research Centre for Cell Therapy Manufacturing. It always had this great technology for making CAR-T cells coming out of that background. And then also I knew members of the team, and these days, you know, I like to work with people that I like, and so the combination of great team, great technology, and a very exciting asset in terms of what is now our lead program. At that time, it was just at the very beginnings of the research that's now led to Carina being a clinical stage company. So being able to be part of the team that steers this asset from, you know, discovery into the clinic via a successful IND filing has just been a tremendous opportunity.
Well, yes, but the issue, I mean, these CAR-T cells, they sort of basically enter the system and they survey the system for threats like cancer cells and stuff like that.
Correct? They do. It's a form of immunotherapy for cancer, and it's a very personalised form of therapy. So about 40-50 mils of blood are taken from a cancer patient. Their cells.
You treat basically blood cancers like leukemia, lymphoma, multiple myeloma, and etc.
Well, all of the approved CAR-T cell therapies, and there's 6 of them now, treat blood cancers. Carina is going after the holy grail, which is a CAR-T cell that can be used to treat solid cancers. And we've got a very unique approach worldwide. We focus only on those drivers of solid cancers. And for example, our lead program targeting a cancer stem cell factor is really targeting the seeds of cancer, the basic biology that enables a cancer cell to proliferate unchecked. And so we really target these cancer stem cell markers. They're important not only in terms of the initiation of cancer, but they're also important for, you know, as I said, cancer being allowed to grow unchecked. And interestingly, cancer stem cell markers like LGR5, and we know LGR5 very, very well, these cancer stem cell factors are actually more commonly found in patients that have undergone unsuccessful chemotherapy. So in our form of cancer that we're targeting first up with our LGR5 CAR-T, patients who have been treated with FOLFOX, FOLFIRI, with BRAF inhibitors, which are sort of the standard of care for certain forms of colorectal cancer, these tumours all express a lot of LGR5, which gives us a lot of target to go after in the solid tumours.
What are some of the challenges of using CAR-T for solid tumours?
Well, the right target has been challenging. Many of the traditional targets have just been too toxic for CAR-T therapy. Going after cancer stem cell markers, really, in our experience to date, has been very safe, well tolerated, and we're continuing on with that clinical trial. So the right target is important. And then having some technologies that you engineer into your CAR T cells that will help the CAR T cells home into the solid tumour and be very potent when they engage with the cancer cell in the solid tumour. And our CAR T cells are able to do this. We've got two technologies, one that focuses on engineering chemokine receptors into our CAR T cells. And every cancer makes a chemokine gradient. Cancer cells secrete these factors called chemokines. And by having a chemokine receptor in your CAR T, it will home using that gradient. It's a bit like, think of Hansel and Gretel following the breadcrumbs. But in this case, it's something that's going to fight your cancer.
Why did Carina choose only to activate Australian trial sites?
Oh, well, we do have an open IND, and in fact, we're the first Australian discovered CAR T cell therapy that has successfully gone to the FDA to get approval or at least clearance to undertake a clinical development program and to then do clinical trials in Australia. We're very, very proud of that. As I said, it's a pathway that we've had to make that pathway, both in terms of our development program and then all of the things that you need to do to run clinical trials. We're really pleased to be actually utilising one of Australia's CAR T cell manufacturers. They're a company called Securities based in Melbourne, and then to have 3 clinical trial sites. At the time that we started our clinical trial, as a spin out from a cooperative research centre, we weren't able to access the R&D tax incentive. So that wasn't a driver in our consideration, but it was about, the philosophy of using Australian service providers wherever possible, building more knowledge in the Australian ecosystem around what it takes to have a new CAR T cell therapy newly discovered, being developed in Australia. Of course, we are talking now to US sites as we get closer to starting the phase 2 component of the trial. We will bring on board a couple of US sites, but it was important to the sort of values of Carina that we undertake our initial clinical trials in Australia and help build that network of service providers that could successfully develop a product and, importantly, provide for those advanced manufacturing skills.
And Carina was basically set up initially as a research centre.
Well, it's a spin out from a cooperative research centre. So It was always set up as a company, but the cooperative research centre focused on cell therapy manufacturing, and it brought together all of the researchers across Australia-wide, essentially, who had an interest in cell and gene therapy, research interest. And so we took that commercial part out of the CRC, and again, that's part of our ethos, again, making sure that technology that was developed within the CRC around CAR T cells could continue its development in Australia and continue to build that skill and expertise that's important and that everyone's looking for around advanced manufacturing and capability.
Now, I take it from what you're saying is you've developed a more efficient CAR T manufacturing process. So where do you see the market? Where do you see the market potential for this?
Well, the market potential is potentially, it's really huge. The current projections around CAR T cell therapy in terms of expanding as a pharmaceutical product is in the tens of billions of dollars by the end of this decade. And of course, early on, the manufacturing processes for CAR T cell therapies were quite long, over a month when we started. And it's important to reduce manufacturing times, to increase manufacturing efficiency so that you get a more potent CAR T product for patients. You've got to have, these are people with cancer. The sooner that you can treat them, the better. So a shortened manufacturing time is certainly helpful for cancer patients, as well as being cheaper to produce.
Well, you're talking about billions of dollars. The biotech sector, particularly in Australia, is notoriously cash-strapped for emerging companies. How have you sourced the funding for the long-term technology development?
So we've just completed a Series A round, and in that Series A round, we've been able to raise in total, 25 million. And that's been sourced from Australian venture capital, Australian impact investors, and Australian family offices, as well as from the universities that are still very large shareholders in Carina. We've been able to access funds from each of our shareholder universities as part of their commitment to growing startup companies.
But you also got support from Forrest's new $250 million health tech venture capital fund.
That's right, from 10 Mile Ventures, which is a dedicated health tech fund, and we're very appreciative of their support. They've been fantastic supporters of Carina, as has the impact fund of the Minderoo Foundation. And, without their support, it wouldn't be possible to do what we're doing. But that support has been very strongly supplemented by other key shareholders, including a particular family office and also from the universities. So the University of Sydney, the University of South Australia, and also Adelaide University.
And you'd expect this to be ongoing as well?
Well, obviously, we're going to look for other investors as we move forward into our Series B financing at some future date. But, I think, we do have a very supportive shareholder base.
Well, Deborah, it's been fantastic talking to you, and thank you so much for your time.
Thank you, Leon.
And now let's talk to economist Nicholas Green.
Well, Nicholas, you've got some concerns about the Public Service Commission and the National Crime Authority not looking into the details about the Robo-Debt Commission.
Well, yes, I'm not the only person with those concerns. Yeah, it's a right royal stuff up, isn't it? Effectively, the Royal Commission into robo-debt got a 1 week delay in its deadline in order that the NAC, the Commission Against Corruption, would be running, and then it referred the pretty disgraceful, well, it was scathing in its report to the NAC, and it thought, I guess, that things would proceed from there. Now the NAC's decided that it doesn't want to, that it's kind of duplicating the process, but it's pretty embarrassing all round, really. So now we can see that unaccountability is the standard, not just for large banks, but also in the public sector. And it's a sort of quietly catastrophic moment, I think.
Well, the Public Service Commission did nothing about it either.
Well, the Public Service Commission has not yet determined what it's doing. But one thing that's very clear is that the Public Service Commission are behaving with exceptional deference, exceptional fairness to all the public servants involved. Now, as people have pointed out, it isn't the contrast between the treatment they meted out to hundreds and thousands of people, to hundreds of thousands of people at the bottom of our society, people on welfare, is just extraordinary. And the public service is not capable of handing out very strong penalties to people. It can reprimand them, it can sack them, but what has happened is is criminal in its behavior, whether it's technically a crime or not. People want to see something happen about that. Alas, nothing much seems to be happening.
I find it quite extraordinary that the NAC hasn't actually done anything about it.
Well, yes. Well, as I understand it, the NAC can't. The NAC, it's a pretty elaborate old process, and the NAC would, in a way, I sort of agree with the NAC that their involvement in some senses is duplicative, because the NAC doesn't prosecute people, it passes people on for prosecution. But it's pretty obvious. I don't know what the Royal Commission's powers were, but it's a pity the Royal Commission couldn't pass people on for that sort of thing. And we need the NAC at the very least to use what powers it has to show that it is doing its best to impose accountability. I'll tell you something else that I find really extraordinary, which is that the NAC puts out this statement and then says it won't further comment on this great thing that it's done, which is to say it won't do anything. It says it won't enter into comment. Now, one of the things that defines the judicial branch of government, and seems to me, I mean, maybe someone will tell me it's not judicial power that's being exercised here, but the judicial branch gives reasons for what it's doing. The commissioner perhaps doesn't want to get involved in TV and radio interviews, and perhaps shouldn't. But I don't get the feeling that this pinnacle of accountability in our system is holding themselves accountable. They're simply issuing an edict and skedaddling and saying we won't enter into further discussion. It just is extraordinary.
Well, also the NAC's workings are not exactly transparent. I mean, no one can actually go there to listen.
Yeah. So that's right. So they've kind of there are some reasons for that, but this is again abuse of that type of secrecy. We should be able to see more and feel more persuaded by its reasoning. And basically what we have is this is a thought that I had a while ago, which is that all of the branches of governments give reasons, but it's only the judicial branch whose reasons are supposed to actually make sense. And what I mean by that is that if you screw up as a lower court, you go on appeal and people say that reasoning wasn't good enough. We don't do that in the executive. The executive says, we did this for that reason, and a lot of the time that's bullshit. It's pretty disastrous if that's what we think about this kind of system.
Well, the outrageous part is that none of these people will be brought to justice.
Yeah, and none of them, I can tell you the name Catherine Campbell, but other than that, we don't know who they are. We don't know. We've got this sealed section. It's an absolute mess. And I've actually been writing some stuff on this in my weekly Substack newsletter, and I've just been going over some of the stuff about the unaccountability of the private sector. And part of that, again, it hadn't really occurred to me that part of the reason for that is firstly, as we know, that there are mates and everyone's been to the same school and so on, but that was the case 20 and 30 years ago. Something that is quite new, I think, is that prosecutors did their jobs as they were professional prosecutors. They were lawyers. They were professionals, the point I'm making there. And today there is, I think, and I can't really prove this, but today I think there is a great deal more careerism, and the whole system works much more in a way that is much more sensitive to the news and all the rest of it. Now, what does that mean? It means that prosecutors are very shy to go after cases which they might lose. And the presumption of innocence is so strong that in most of these cases, they might lose them. So we just sit around watching while people do utterly egregious things and are part of a system where someone like Colleen Taylor, who recently got an award in the Australian Day Honours, said this stinks. I would like to mention, just by the way, that a nice little touch is that Colleen Taylor was given an award essentially for heroism, for bureaucratic heroism, for saying this must not stand. We are defrauding the people we're supposed to serve. And she was given an honour. And of course, we managed to give her the lowest honour we have. We have 4 levels of honour, and we gave her an OAM and a medal. And Catherine Campbell, who sat at the top of this system for a long time, essentially knew what was going on, was part of engineering what was going on. She still got her AO, that's second top award. She's sitting there smiling with her AO, and we hand a nice little thing to somebody to say, well done. You actually perform. You are one of just a few in hundreds who actually performed your role as listen to the words, public servant.
But at the same time, Catherine Campbell is still part of the same system, and as is the Public Service Commission.
It seems.
And as would be NAC as well.
Yeah, that's right. Well, everyone gets a medal.
It's a nice little coterie there.
It is indeed. It is indeed. And yeah, it's not a bad club not to be part of.
But look, in the business world, that would be known as a cartel.
Well, you can say that's in the yeah. If it was about pricing, it would be known as a cartel. I thought you were going to make the point that there's a fair bit of this sort of thing that goes on in business, and that's true too. You might remember the Sure Currency scandal, where the Reserve Bank and the Reserve Bank governor knew that there had been criminality in this subsidiary and basically covered it up. And that became known to the treasurer of the time, Wayne Swan, and it was all sorted out by sound chaps. Now, I'm not making now that's not necessarily criminal behavior. It's certainly not behavior of an accountable public servant. And
it's something that we would expect public service should actually deliver, because they are, after all, public servants working in our interests. Yeah. My guess is, and this is only a guess, that 20 or 30 years ago, things would have been substantially better, but I can't prove that, and I might be wrong. Well, Nicholas, that's all quite illuminating, and thank you very much for your time. Thank you.
So what's happening in the news? Well, financial giants from Goldman Sachs to Morgan Stanley and Barclays are taking a fresh look at how a Donald Trump victory in November could play out in the bond market. After last week's debate hurt President Joe Biden's chances of winning re-election, Wall Street strategists are urging clients to position for sticky inflation and higher long-term bond yields. At Morgan Stanley, strategists including Matthew Hornback and Gunit Dhingra in a weekend note argued that now is a time to wager on long-term interest rates rising relative to short-term ones. Trump's rise in the polls since Thursday's debate means investors have to contemplate economic policies that could lead to more rate cuts from the Federal Reserve, along with a Republican sweep that leads to fiscal expansion and pressures long-term bond yields higher, Morgan Stanley said. Barclays, meanwhile, said that the best response to the rising prospect of a Trump victory is to hedge against inflation. Strategists Michael Pond and Jonathan Hill wrote on Friday that the clearest expression is a wager that 5-year Treasury inflation-protected securities, or TIPS, will outperform standard 5-year notes. Buy-side investors like Jack McIntyre, a portfolio manager at Brandywine Global Investment Management, are increasingly taking note. McIntyre said he's worried that the bond vigilantes are coming out early in response to the debate fallout. The odds of a Republican sweep in November will increase from a combination of Biden's performance, weaker data, higher oil prices. US Treasuries fell on Monday, pushing yields to the highest levels in weeks in what traders said was ongoing fallout from last week's bump in the odds of a second Trump term. Treasuries extended their losses after the Supreme Court ruled in a case that will limit the chances that Trump will face trial before the November election on charges for attempting to reverse the 2020 election results. Now, the uptick in Treasury yields was led by the longest maturities, with 30-year bond yields up as much as 9 basis points to a session high of 4.65%, the highest level since May the 31st. Now, not all on Wall Street are convinced that higher long-term Treasury yields and steeper curves are inevitable. While a term Premier-driven sell-off has been consensus for how US yields should react to a Republican victory, we see arguments for flattening risk, Goldman Sachs strategists led by George Cole and William Marshall wrote after the debate. They see investor focus shifting away from fiscal spending and towards the risks of higher tariffs, which are likely to weigh on productivity and growth as the election comes into view. and central banks should avoid cutting interest rates too soon, owing to the risk of a fresh flare-up in inflation, the Bank for International Settlements has warned, as policymakers around the world weigh up how quickly to ease monetary policy. The Basel-based umbrella body for central banks said in its annual report that the global economy looked set for a smooth landing as inflation cooled and growth remained resilient, but it urged rate setters to set a high bar for policy easing, warning of a risk of a resurgence in areas such as services prices and wage growth, as well as a need to maintain some room to slash borrowing costs in the event of a sudden downturn. It also warned that the financial system remained vulnerable, particularly to high levels of public debt and fallen commercial property prices. A premature easing could reignite inflationary pressures and force a costly policy reversal, all the costlier because credibility would be undermined, the BIS said. BIS General Manager Augustin Carstens praised the forceful tightening that eventually ensued, arguing it reinforced central banks' credibility and preempted a shift to a high inflation regime. But the BIS warned top officials to remain on guard for a return of inflationary pressures, even if some central banks had already started to ease policy. The ECB began to cut rates in June, while the Fed is expected to lower borrowing costs as soon as September. Now, comparing a central banker fighting inflation with high interest rates to a doctor giving antibiotics to a patient with an infection, Carsten told reporters, "You have to do the whole treatment, otherwise inflation might come back." And China's factory production contracted for a second straight month in June, signalling weakness in an area that Beijing is betting on to drive the economy of Australia's biggest trading partner. The official Manufacturing Purchasing Managers Index was at 49.5, the National Bureau of Statistics said on Sunday. That was the same reading as in May, and in line with economists' predictions in a Bloomberg survey. Now, any number above 50 points to an expansion. A sub-index of new orders at factories inched lower to 49.5 as demand weakened, while a gauge measuring new export orders was unchanged at 48.3. Meanwhile, the non-manufacturing measure of activity in construction and services fell to 50.5, the Statistics Office said. That compares with a forecast of 51 and a May reading of 51.1. China's economy has performed unevenly this year, with manufacturing at times a bright spot, while consumption has been weighed down by a prolonged real estate crisis. The continued contraction in the factory sector poses a threat to the country's economic growth target of around 5% this year. Trade tensions have added to the challenges. The US and European Union, two of China's biggest export markets, have sounded the alarm over a surge in cheap Chinese exports, which they say are unfairly bolstered by Beijing's massive subsidies. Both have threatened to impose tariffs on China's electric car exports, along with other sectors where Beijing is leading on price. And the pain of this economic downturn will be more widespread and hit consumers harder than in the global financial crisis, and the rising company collapses may soon spread from small to large firms, warns McGrath-Nickel chairman Jason Preston. Unlike the GFC, which was a top-down crisis caused by lax oversight of financial institutions that led too much to low-quality borrowers who defaulted when house prices fell, this period of economic decline is bottom-up, he said. From an everyday Australian consumer perspective, the GFC wasn't that bad. We didn't see high unemployment and we didn't see high inflation, he said. Whereas what we're seeing now is much the other way round. We're seeing interest rates and inflation almost impact from the bottom up. Mr. Preston, whose firm was spun out from KPMG, said a sustained period of high inflation had dampened consumer spending to a point where companies were losing the confidence to invest. Last week's jump in inflation above market expectations has put yet another interest rate rise on the table for August or September. That meant the tough conditions would continue for another 12 to 18 months or worsen, and the rise in insolvency appointments seen in 2023-24 would spread, he added. And artificial intelligence will create 200,000 jobs in Australia by 2030, according to a report backed by Industry Minister Ed Husic. More than 160,000 of those jobs will be in tech-related occupations, but the rest will be for non-tech roles, such as sales managers, accountants and human resource managers, all of whom will be required to help pave the way for AI. The report, Meeting the AI Skills Boom, found that Australia and New Zealand already have the second highest uptake of generative AI software anywhere in the world, with 84% of knowledge workers reporting they use software such as OpenAI's ChatGPT, Microsoft's Copilot, or Google's Gemini for their jobs. Only Singapore workers reported a greater usage of generative AI at 88%. But if there were even greater uptake of generative AI in Australia, it could contribute $115 billion to the economy, mostly through productivity gains, the report found. The report was prepared by the Tech Council of Australia, a peak industry body that represents the interests of huge AI companies such as Google, IBM and Microsoft, as well as Atlassian, Canva and Adobe, all of which use AI to automate tasks previously done by human workers. It was sponsored by Microsoft, which helped fund the development of OpenAI's ChatGPT and which offers generative AI tools in all its software, as well as by the Microsoft subsidiary LinkedIn, and by Workday, which uses AI in its enterprise management software. Amian Kasabgai, Chief Executive of the TCA, said if the history of the tech sector showed anything, it was that far more jobs were always created by automation than were destroyed by it. But Mr. Kasabgai said that even to reach the figure of 200,000 jobs, there needed to be a huge increase in the number of skilled AI workers in Australia, which at the end of 2023 sat at just 33,000. Much of the increase would need to come from reskilling existing tech workers, but some also needed to come from overseas, and a rethink of Australia's skilled worker visa system was also needed. And following cyber attacks on Medisecure and Monash Health, the Albanese government has injected a long overdue $6.4 million into boosting cybersecurity in Australia's healthcare sector through an information sharing network. Mirroring a model already used in the financial and critical infrastructure sector, the Pilot Information Sharing and Analysis Centre, ISAC, will focus on cyber threats, responses and preventative measures among health organisations. Minister for Home Affairs and Cyber Security, Claire O'Neill, said healthcare organisations' access to sensitive data and their struggle with building and funding strong cyber protections had made them a threat target. The last 2 years had been the beginning of a big overdue national journey to lift up cybersecurity across the country to better protect our citizens, she said. Healthcare faces a vulnerability trifecta. Cyber criminals know that every Australian depends on these essential services and they cannot afford to be offline over extended periods. O'Neill added that government intervention to kickstart ISAC-like networks in other high-risk sectors is long overdue. This year, the health sector once again ranked top in the Australian Information Commission's data breach reporting. And the Australian Securities and Investments Commission has found that the construction sector remains by far the single largest category of insolvency. Unprofitable building contracts, cost blowouts, planning delays, labour shortages, red tape and other challenges sent nearly 3,000 building companies broke in the last financial year, new official insolvency figures show. According to corporate watchdog ASIC, there were 2,832 construction industry insolvency appointments for the 2024 financial year until June 16, an increase of 28% on the 2,213 insolvencies over the previous financial year. The next worst performer, accommodation and food services, had just 1,600 corporate failures, highlighting how sharp the downturn has been for builders since the cost of construction surged after the pandemic, resulting in many fixed-price contracts becoming loss makers. Insolvencies have more than doubled from the 1,200 failures recorded in the 2022 financial year. And the number of businesses on TikTok has jumped, with smaller firms joining corporates such as Telstra, Coles and Woolworths at the same time as the Victorian Chamber of Commerce strikes a deal to train owners on how to best use the social media platform. The Chamber has announced a new partnership with TikTok to help business owners set up and understand the tips and tricks amid warnings the platform can backfire for businesses that get it wrong and spark a cringe factor by trying to seem cool. The deal comes after a survey of 47,000 members showed that expanding brand and marketing presence was a top priority of business behind growing their revenue. And while Facebook and Instagram remain the country's most popular social media platform, they are losing ground to TikTok, according to the latest We Are Social's Digital Australia report. TikTok users have hit 9.7 million people, or a third of all Australians, and it has seen a 17% annual growth. Users are also spending more than 42 hours on the platform per month, double the next platform, YouTube. While about 350,000 businesses in Australia use the platform, big business has been more cautious, but increasingly say they can no longer ignore TikTok. ING is trialling TikTok-style videos on LinkedIn for new job ads, using short and fun videos with local managers. Upbank, an independent arm of Bendigo and Adelaide Bank, launched a campaign that encouraged users to catch and munch flying coins. Telstra was an early adopter after identifying in 2020 that TikTok was quickly becoming the platform of choice for Gen Z and younger millennials, an audience we historically struggled to reach and meaningfully connect with, the spokesman said. And Australia's peak research agency, CSIRO, has spent $15 million on a new supercomputer that it says will speed up scientific discovery, helping grow the national economy. US tech titan Dell built the computer cluster dubbed Verger, the meteorological effect of rain that evaporates before it reaches the ground. It features NVIDIA H100 chips, which cost about US $25,000 each, which the agency says will allow it to complete power-hungry artificial intelligence workloads. While AI has attracted much hype, with the tech giants branding it on almost every new product, CSIRO says its application on the high-performance computer, or HPC, will deliver tangible results. Jason Dowling from CSIRO's Australian eHealth Research Centre said medical imaging analysis was one application in which AI can deliver a significant benefit, effectively giving doctors a second pair of eyes. Eleanor Huntington, CSIRO's Digital National Facilities and Collection Executive Director, said AI was used in practically all fields of research, including developing flexible printed solar panels, vaccines, predicting fires, and measuring wheat crops. High-performing computing systems like Verger also play an important role in CSIRO's robotics and sensing works and are crucial to the recently launched National Robotics Strategy to drive competitiveness and productivity of Australian industry, Ms Huntington said. CSIRO said its high-performance computer, which has 94 gigabytes of high-bandwidth memory per graphics processing unit, will significantly speed up AI performance, training large models within days or even hours. Other hardware includes 4th-gen Intel Xeon scalable processors. And that's it for this week. And next week I'll be talking to Leslie Chong, the CEO and MD of Imagen, and has been instrumental in building it from a new company with one technology to a leader in Australian biotech with 5 different clinical trials underway targeting a multitude of cancer types. And I'll talk to economist Saul Eslake about how Australia will be faring with the latest inflation figures. For the most exclusive access to leading economists and business leaders from around the world, subscribe to Talking Business from my website, leongettler.com. If you like Talking Business, please leave us a review with Apple Podcasts. Thank you in advance. In the meantime, you catch me on Facebook, Twitter, Instagram, LinkedIn, and YouTube. If you want to contact me, email me at leon@leongettler.com. I answer all emails. Also, in my copious spare time, I have a copywriting business. If anyone needs newsletters, blogs, articles, or advertorial, email me. Wishing you all a safe and healthy week, and looking forward to bringing you Talking Business next week.